Hey, yo, boss, it's time to get this money.
I hope everyone's doing well. Welcome back to another lesson. So today's lesson is going to be about risk and trade management, right? So both of these very key to being traders. So now you guys have learned a lot of technical things off me, and of course I've touched on this repeatedly in the group chats and in the outlooks and so forth, and even one-to-one with most of you guys. But this lesson will overview pretty much everything we need to consider under risk management and under trade management and how we can approach everything. So let's get into it. So the first thing we're going to talk about is risk management, right? Risk management is make or break to your trading career. It's something you have to have. You have to have it pinned down, and you need to have a plan for it. You need to know what you're doing. You can't just go into trading and freestyle with your risk. If you do that, I'm pretty sure a lot of you have done that, and you know how that ends up. Coming into trading, a lot of people will full port. They don't even consider delegating margin, which I'll talk about, explain what that is in a second. And they just use their whole account, their whole balance. And what happens after that? Most people lose their accounts, right? Makes sense. So cool. So let's talk about what balance and margin actually is to start off, right? What's the difference? If you trade futures, crypto, you're probably a bit more familiar with it. The forex guys, I understand you might not be. So let's just say we have 100k in account, right? That's the balance, and the margin, right, is how much we're going to delegate to each trade, or rather, we can just call it the risk on each trade. Now, typically, the way I've taught you guys is 1% a trade, right? So let's just say we got a 100k account, we're risking 1k loss maximum per trade, right? So cool. Why do we do that? If Right, let's just forget about funded accounts for a second. Let's just imagine we had a normal account. We just had a normal 100k account, just literally cash, and you're risking 1%, right? Why are we doing that? If you lose that trade, right, what's going to happen to your account? Go down to 99k. Is that worrying? No, that's fine. Losses happen in this game, right? And a 1% loss, that's not going to hurt you. That's not going to set you back, a lot. But let's just say now, yeah, you put your whole account in that trade. But let's just assume you don't even blow your account, but you just lost 20%. You just lost 20% of your whole account. Imagine you just lost 20k. Imagine the implications of that, the after effects. It's like a domino effect, right? Don't just think about your account, because now you're stressed. You're trying to think, how do I make it back? But there's so many things to consider. When it's a 1%, when it's controlled risk, right? When you know what you're doing, you're going into a trade understanding, okay, is this setup worth me risking 1%? And you've had that whole thought process. You said, yes, it is. And now you risked it. So if you lose it, you know you took that setup for a reason, right? The way I look at, even losing setups sometimes, of course, when I lose setups, I'll go and evaluate them, I analyze them. But a lot of the time, the question I ask myself is, if this setup appeared again, right, and the context, the thought process I had, would I be taking this trade again? And if the answer is yes, it's probably a trade I should be taking right now, right? And of course, you will lose, like I just said, and that's just something you consider after. And we go over, I'll cover that in a different slide as well. So cool. So understanding, of course, now you guys should have an idea of what the margin is and why we delegate 1%. We have controlled risk. So if you don't have controlled risk, you're not going to make money. You're just going to lose money. And if you lose too much money, it's going to be harder to get back to point zero. Starting off at that 100k, if you're now down to like 80, 70, 60k, to even make profit first, you have to make 40k. You get it? But if you've lost 1k, to go back into profit, you just need to make 1k and a bit more, and you've made profit, right? Quite simple. So cool. Now, risk to reward. There's a couple ways to look at this, right? Of course, there's the very just a normal way, like what is risk to reward on a chart? Or I'm risking 1% for a potential 2% return, 3% return, 4%, whatever, right? But it's quite dynamic as well. It's not just risk to reward quite literally on your chart. If you want to trade today, let's just say earlier in the day, the risk to reward in this scenario isn't just 1 to 2. Right? Let's just say you won 2%, or let's say you won 1%, right? You won 1% in London. Now New York kill zone has come, and you see another setup, and you're thinking about taking it. Now, if you take this setup and it loses, and you lose 1%, what happens? you go back to zero, right? Now, cool. You might think, okay, that's fine. I'm back to zero. I didn't lose anything technically, but really and truly, you do. If you made that 1%, hang on to your profit, right? I'm going to talk about that more in a second, but it's good to hang on to your profit. See risk and reward as something dynamic. Based on your past movements, meaning like, what you've just done, what's occurred in the past day, the week, the month, whatever, that's how you have to go ahead and make a plan and assess what you'll be doing next. Now, static and dynamic risk, again, very important points. So, a lot of traders probably do trade with static risk, meaning every setup, they'll risk the same amount. Now, there's an argument to be made for both sides, right? It's very, very contextual. It depends how you trade, what you're willing to trade. And I understand why people do it, why they risk the same amount each trade. In a way, it's quite easy, understanding, every time I'm just going to risk 1%. Dynamic risk, rather, is changing how much you risk, right? Dependent on whatever. So let's use that example I used 2 minutes ago. Let's just say you've won 1% in London, you've come to New York, you see your setup, but instead of risking 1%, you risk 0.5%, 0.5% risk, right? The trade loses. Now what happened? You're still up 0.5% for the day, right? And if that trade won, let's just say you would have made another percent, it's still worth it, right? If you genuinely think it's a good setup, you're ready to take it, cool, then that's a much smarter way to do it, isn't it? Because either you're going to lose 0.5% and still be up for the day in profit, or you're potentially going to make another percent, right? That's what will happen to your balance. So dynamic risk, I think, is important. Having that included. Of course, it's not the same for everyone. For the people that only trade, perhaps once in a day, you might just risk 1%. Only if you see a perfect setup, a setup that ticks all your boxes. That's fine. These rules are for you guys to make. I'm just exploring the different options you could have here, different things you can consider. Me personally, because I know people will ask, the way I do it is I take 2 trades in a day, maximum. The first trade, only if it's a good setup, I will go in, of course, and risk 1%. If that trade is a loser, right, and I see another setup appear later on, I will risk 0.5%. And I will usually aim for, a 1 to 2, meaning I'll either go back to, just back to where I started, or I might end up in a little bit of profit. Because the aim of that second trade for me personally isn't essentially to make a lot of money. It's to, just win back the losses. We have to protect our capital. That's what we call it. If I've made money, I want to hold on to my money. If I'm in losses, I want to make back my losses, right? It's not always about hitting a home run. And next point, right? That ties into what I was saying. If I've had losing trades, I've had a bit of a, let's say losing streak, I'll refrain from risking 1% back to back to back. I will I'll reduce my risk and slowly work my way back up to 0.0. And then from 0.0, I'll try and build a buffer. So the way I trade, right? Again, let's use the example of a 100k account. My initial trade, I will try and take a 0.5% risk trade and try to go to 101k, go 1% up. So now the next trade that I will take, right, I will risk 1%. So what happens when I risk that 1%? I'm either going to make back, typically I aim for 2R, right, around 2R, depending on what the market's given. I will either go to 103k, or I'm going to lose and come back to 100k. And from then I can build a buffer again. So what's that buffer doing, right? It's acting as a cushion. It's making sure that I don't go into a loss, straight away. Because when you go into a loss, tying into the next point, it changes everything. People underestimate it until you're actually there. When you're sitting on a chart, when you're sitting trading, and you're taking these losses and you really think about it, you just think, oh, I'm in a loss, I need to make it back. And then when you think, I need to make it back, I need to make it back today, and you do it in the next session, the next hour, you put unnecessary pressure on yourself. So why not start by creating an environment that ensures that even if you take a loss, right, you're still in the game. You're just at 0.0, you restarted, that's fine. The market's not running away, you just wait for the next good setup, get involved again, right? It's quite simple. Just have to be very robotic about it and think about the future, in the sense that if you take a loss today, it's not necessary that you have to make the loss back today. You don't have to make it back. tomorrow or even this week if nothing good appears. It's about having the patience to wait for the right setups, because when you wait for the right setups, you probably will make it back, right? But if you just try and force it, you might just end up digging a deeper grave for yourself. And the deeper and deeper you go into drawdown, the more loss you have, the more pressure starts building on you, and the more likely you are to do stupid stuff. Because, if you made it to these videos, of course, I'm expecting that you trade or you have some sort of experience, and you know that if you don't manage your risk, if you trade like a bit of a cunt, let's say, when you start going back and forth, you're just thinking, I need to make it back right now. It does not end well. And if it ends well, that's also not good, right? Although you might think, oh yeah, it ended well, I risked like 3% and I was in a 4% loss, now I've made it all back, I'm in profit. Cool, right? Good for you, you're back in profit. But now you've kind of just set this precedent in your brain that, oh, when I over risk, as long as it's the right move and I over risk, right, I can make it back into profit. You set a bad precedent for your brain, because if you're ever in drawdown, you might do that again. And if the next time it doesn't work, that is not going well for you. Risking something like 3% on a trade is very crazy. Now, in this whole time, I've just been speaking about accounts in general. When you take in the fact that on a funded account, you have a limited amount of overall drawdown, for most accounts it's 10 or 12%, and you have a limited amount of daily drawdown, which is typically 4 or 5%. So sticking to that 1% risk, the 0.5% risk is very smart. Protect your capital. If you get funded, you want to stay funded, you have to manage your risk. That's the only reason people fail, right? What's the ways to fail when they're funded? Typically, I know some of them have weird rules, but typically the only two ways to fail is not hit or, going into your daily drawdown, which is usually 4 or 5%. If you're losing 4 or 5% in a day, you're doing something very wrong. The other way is losing 12% overall. To me, that's a bit more plausible than losing 4 or 5% a day. The fact that you lost perhaps 2% and you just didn't call it a day, that's not a good thing, right? Sometimes, I know it's very frustrating, guys, you're in a loss, you see a good trade and you just think, let me take it. But you see, when you're in a loss, you might not realize it in the moment, but your brain kind of makes you see things you want to see. You have to be extremely, extremely objective when it comes to the charts. And that's something you build up with time and experience, right? Now, moving on to trade management, right? So cool, that's risk management. Risk management is something that's quite comprehensive, and trade management falls within that. Risk management is something you just have to consider generally all the time, right? And our trade management is what we consider within the actual trades, right? So the difference really, what I would say, is risk management is thinking, oh, perhaps you're on a losing streak going into the next trades and so forth. You have to risk a certain amount, or you only take this sort of setup, or blah blah, right? A lot of things to consider. Trade management, now what we're going to speak about, is when you're in a singular trade, how do we manage that position, right? So cool, you're in a trade as normal, you've got a stop loss, you've got to take profit, right? The first thing I like to talk about, very basic, I've taught you guys this so many times. Please, please, please always have your stop loss at an invalidation point. Do not try to squeeze your stop loss, right, and make it tight as possible. Put it at the end of a fair value gap, for example, instead of the low where you should be putting it, to try and squeeze that RR. Don't do that. It's a lot of the time, what might happen, of course not always, but what might happen is you get taken out. Price didn't take out the invalidation level, which will be, like, let's say the low, the swing low, and then it flies away and hits your TP, but you got stopped out. Then you're going to feel dumb after, right? So always have your stop loss at an invalidation level. Then same with your take profit, have it in a logical place. Now, one thing I've touched on, right, and now I've taught you guys the PD array matrix, you should understand. Sometimes instead of putting my take profit at the high, let's say I'm in a buy, right? Instead of putting it at a high, I might put it at the end of a candle body. Why? Because price might find, resistance at that rejection block. And we find a rejection block at the end of the PD array matrix. So small stuff like that. If the difference is 1-2 pips, then just take it. You're gonna live to see another day. You're gonna live to take another trade, so it's fine, right? Same with your entries. I've taught you guys we consider premium and discount, right? Don't aim for the lowest array every single time. it is unlikely it's gonna get hit every single time. Of course, sometimes, yeah, but more times than not, price comes into a premium, delivers around like the midpoint or before, and then moves away. So always consider the first premium array, discount array, whatever, and have your stop loss in a sensible place, and same with your take profit, right? And your take profit especially should be very reflective of your trading plan and the type of sales you take. Again, that's something that's going to be, unique and individual to each of you. You have to figure out for yourself, right? So cool. Now the second thing that I want to talk about, time and structure together, right? Let's say you've entered a trade and it's London up on kill zone, and now your trades, it started to go your way. You're in a buy, let's say, and London up on kill zone's done. Now, of course, it's London lunch and then New York. Is it worth still holding that trade? That's something you guys have to consider. You have to think about time as a whole. What is London lunch known for? Engineering liquidity. Now, if you have to think about where your stop loss is it possible my stop loss could get taken out? Could it get used as a low that we offset from in New York, right? Stuff like that. Understand that just because your stop loss was safe then, in London open kill zone, doesn't necessarily mean it's safe in New York, right? I know a lot of people like taking trades on the lower time frame, the 1, 3, 5 minute, whatever. Yeah, that's fine. If you're confident with it, that's fine. But consider your high time frame, right? And consider time in the sense, and I've said this to you guys so many times. Think to yourself, once London is done, just think to yourself, has the high or the low of the day been put in? Has one end of the range been put in? How do we gauge this? Your midnight price. Have that line drawn on your chart. Use all the tools, because they will, not only will they help you technically, right? Technically in the sense of, price is going to go here, do this, but they're going to help you be sensible in your risk and trade management. They'll give you confidence, and vice versa. They're going to make you feel shaky when certain things aren't happening. And that's a signal to you, or maybe I should skim my trade. Maybe I should partial hit, right? Maybe I should bring my stop loss to break even, right? There's always something you can do to ensure you're making money or protecting your capital. Because when I was speaking about risk management a bit ago, what was I saying? The point of all of this is protect your capital and make sure you make money. Why do we trade? Of course, we trade to make money, right? We're trying to make a living from it. So ensuring you're constantly making money is very important, especially in trading where, you might have months, weeks where you might not see great price action and it gets very choppy and it's hard to trade. So as a trader, right, having that money management within trades is very important. So I know some people will struggle with that in the sense that, let's just say you got a 10k account, and you're up 0.50, and you might not partial because you think, it's just $50, right? Cool. And I understand the angle, but it's a habit you guys have to build. It's something you need engraved from the start. That 0.5% on a 300k account, right? How much is that? That's 1.5k. Let's just imagine you started your day and you just made 0.5% and you had to cash out because you thought the trade's not going your way. Not going to be upset if you made 1.5k, are you? Same if let's just say you had a 600k, that's 3k, 0.5%, right? Think like that, guys. Especially when you get funded, I will touch on this more in a different episode. Think about the future. Build the habits for being able to handle those big accounts. Don't just think, I've got a small account, I need to maximize how much money you make. I've got a 5k account, so I need to make 10% to have, $500. That's like a good amount of money to me. Because making 10% in a month is not realistic, at least not each month. Of course, it might happen here and there, right? You have to understand that when you're actually big funded, you could live off 1% a month on a lot of accounts. Let's just put it this way: 300k account, 1% a month. Yeah, can you live off that? You're probably making more than what I believe is the average wage in the UK, right? 3%. That's that. Yeah, so it's around like the average, or just above the average yearly wage in the UK. It would work out to 36k, let's say, right? 3k a month. But of course, no one's saying 300k is your ceiling, right? So think about the future in that sense. Of course, this isn't stuff you need to think about every time you're in a trade, but it's something you need to engrave in your brain so that when you're in a trade, you don't feel away thinking, I need to maximize my take profit, I need to maximize my RR each time. You just get so used to being right in your trades. You're just worried about being right. You're worried about making money, protecting your capital. That's it. So cool. The next thing that I want to talk about is leaving runners and closing trades. Right now, I have this sort of rule where I will take a local take profit. My local take profit will usually be 2 to 3 R typically, right? Most of my setups, sometimes a little less. At that local take profit, I will shave 80% of my trade. Because what's happened now? I just took 80% off the table. Again, let's use a 100k account for example, right? Let's just say my take profit was 2R, right? My local take profit, meaning the one that's close to my entry, and I take off 80%, right? How much do I have? $1,600, right? Think of like the actual money in it for a second. And I've left, 20% on the table because I believe this trade can run far. You don't have to do this. This is only if you think your trade will run far. You leave a runner. That, that 20% you left, let's just say your trade runs another 3-4R. That could make you 1% back. You already made 1.6%, but now you end up with 2.6% in total. Not going to be upset. And you, of course, you trim your stop loss as well. If worst comes to worst, you don't take a loss, right? If you've taken profit, you're going to be taking profit at a point of liquidity, right? A liquidity pool. Meaning there's probably going to be a breaker structure or something, meaning you can probably move your stop loss up to somewhere that's a bit safer, typically your entry. Now, in terms of closing trades and losses, now like the flip side of the coin, we've spoken about taking profit. When do we close? Why should we close? Now, if a trade is heading towards your stop loss, right? This will tie into the last point, psychology in trades. Don't panic, right? Especially, let's say you took the first discount array, sorry, and the trade is, heading lower. Understand, first of all, is there, an array below that? Let's say you entered off a fair value gap, but a bit lower, there's an order block, then there's a rejection block, right? Again, refer to your PD array matrix. It's possible price trades that order block, so you suffer a bit of drawdown, then it trades away, but that's fine. Possible price trades past that, go to a rejection block, then heads your way. And then below that, what's happening? You have your stop loss. You have in a safe place. You know that if this level gets violated, then there should be either you're not trading at the right time, there's some sort of seek and destroy profile, news coming up, or manipulation happening, or you just simply had it in the wrong place and now price is going to reverse. You just had the wrong idea of what price you're going to do here. That's fine. That's something for you to reevaluate after. Now, again, on the other side of the spectrum, don't panic when, of course, price is heading towards your stop loss. Understand what's going on, what the price action is doing, where it could reverse from. But at the same time, you have to know when to close your trades. And what do we consider for that? Some of the stuff I just mentioned. If there's news coming up, if it's very close to news, let's say, for example, you're in a trade, you're in a 0.5% loss, and news is in about 10 minutes. I would most likely close that trade. I probably would have closed it earlier if I could, right? I wouldn't wait till 10 minutes before news, but I know some people end up in those scenarios. It's a battle with psychology sometimes. It's worth closing that trade. But if news comes and then you just end up taking the 1% loss, cool, maybe you're like, oh, it's whatever. But it's the fact that you can prevent that. That doesn't need to happen. And I know, guys, it is very frustrating if you close and then it goes your way. But that's part of the game, right? Remember, what's the whole objective of this risk and trade management? Protect your capital, maximize your earnings. You're not going to maximize your earnings by gambling on news. Cool, sometimes news might go your way. But what if it doesn't, then what? What if you get slipped? That some of you guys might not know what slippage is, right? Let's say your stop loss is at a level, your stop loss is 8 pips, yeah? And it's a big news event. Let's say NFP. This has happened to me before. Generally, this is like ages back, but I remember this. I had a stop loss of 12 pips, right? And NFP dropped. And I held through the news thinking it's going to go my way, right? And I'm going to make a lot of money. Didn't happen. My stop got slipped, right? My stop loss got slipped. Guys, it got slipped to something stupid like 44 pips, which is over 3 times how much I was risking. I was risking 12 pips and I got stopped out at 44 pips. My account got blown that day. I'd already taken a loss, and then when that loss hit, that's it. Account was gone. That's stuff you want to avoid, guys. It's so simple. When you see the big news events, especially, just don't do that to yourself. And if it goes your way, I understand you'll be frustrated, but you have to tell yourself how many times does news happen, like those big news events, just once a month, really, right? You have so many other days in a month to trade. Just wait for the next good opportunity. That is not a good opportunity if you're trading around NFP or FOMC or CPI, for example, right? And everything I've talked about now has touched onto that last point, the psychology in trades. You just have to be very organized, guys. When we go into trades, you need a very solid thought process. The way I think of it is like ticking boxes. Am I bullish on the day? Am I bullish on the weekly? What day is it in the week? Does it make sense for us to be bullish here? What is price heading towards? Where did it come from? Where was the last liquidity pull it sweep? Where do I expect it to go? What time of day is it? Am I in a kill zone? Is there a clear entry? Is it a premium discount? Does it make sense for me to take this trade? Do I need to reduce my risk because I lost my last trade? Right? A lot of things to consider, but just take it all step by step. Because when you're organized and you do everything step by step instead of being impulsive, your psychology feels so much better. Because even if you still take a loss, you know that this trade ticked all your boxes, so you didn't impulsively take this. You didn't take this trade for, just being dumb. You took it because everything was logical and you had sound reasoning for taking it. That's how it should be every single trade you take. So cool. The last thing I want to touch on, and this will tie into the next lesson, which is it's called environment and headspace. Will be a very interesting lesson. Is losing. Now, as I started, guys, losing is part of the game. You will never be winning 100% of the time. You might go on win streaks, but you won't have like a clean run for a year, right? It's unless you literally take like 2 trades in a year or something and just say, I've got 100% win rate. It's, being realistic. When you're losing, it's fine. Like I said, it happens. You have to consider your next steps. Now, we've spoken a lot about reducing risk for your trades. That is something you need to do. Another thing is reevaluating, right? Why have I put such a big emphasis on data collection, guys? I tell you, journal all your trades. Journal so many different things, right? Keep that data. If you journal your trades and you see, in London, I have a 60% win rate, but in New York, I have an 85% win rate. Just cut London out. Just trade New York. Why would you not keep that 85% win rate? Think about it. You're going to preserve so much capital and, of course, be positive more of the time. You know how I say all these things about essentially when you take losses, it affects your psychology and it's kind of like a pit that you're falling down and gets deeper and deeper. You kind of have the reverse when you're doing well. If you have 85% win rate, you'll feel more confident and you're going to stick to your system more. You're more likely to break your system when you're in that loss and you're thinking, this isn't working, I need to do something. And that something will usually end up being something impulsive and stupid, right? So when you are taking a few losses as well, you have to reevaluate what you're doing and trading. Again, like I just mentioned, the London Open and New York, comparison. Maybe you should just start trading New York. Maybe you need to go and back test your strategy. Are you trading it right? Are you doing the right thing? Are you waiting for the right things? Are your trades ticking all your boxes? That example I gave a bit ago, I literally listed like 10 different things that you need to consider, right? Now imagine everything's fine, but for some reason you just don't feel confident. You just don't feel okay on the charts. You can take breaks. Now, a lot of you guys in here with me at the moment, you're not funded. That's fine. In this game of trading, it's about longevity. Everything I've been saying to you guys from the start is think about the future. Especially when you're managing risk and stuff, think about when you have a lot of capital. You can take breaks, get your headspace right. If you feel stressed and stuff, you have external factors that are stressing you out, it will be very, very hard to be a good trader, right? Unless you're just so sick at controlling your emotions. But most people aren't. Guys, in this game of like trading, right, it's very cliche, but us as traders, people who are learning and do it, we can speak about, we understand how much of a challenge it is. People outside don't understand that. So it's a very internal battle with yourself, right? Taking all these losses, dealing with your own psychology, knowing you're impulsive and, fighting against it, things like this. Sometimes you have to take breaks and just work on yourself and then get back to trading. And when I say breaks, I'm not saying, go sit away from the charts for like 2 months. But a break could simply be, oh, I'm at the charts every single day watching price action, but I'm not trading. I'm building my confidence up again. How do you build up your confidence? You sit at the charts here, and I've given you guys this exercise. You say, oh, the next daily candle will trade up or down. The next session will trade up or down, right? And when you start getting it right, because you've been paying so much attention, because you've been studying, your confidence is back. And when your confidence is back, what? Just get back in the market. It's time to go again. You'll know when you're ready. If you don't feel ready, you don't have to do anything. No one's forcing you. But you need to have that confidence. But that confidence needs to be backed by something. And that's usually backed by practice, back testing, whatever. Right? So just keep working. And the last thing I'll touch on is blowing accounts. And that'll tie into taking breaks. Everyone I know personally has blown an account, right? And I'm not going to say it's part of the game. It's not something that's necessary. It happens because people jump the gun. They're very impulsive. Now, on the flip side, I know someone who passed their first funded right now. And, well, me personally, I didn't pass my first funded, nowhere near. But that person who passed their first funded demoed non-stop for 4 or 5 months, which is a very long time. But guys, again, long-term vision. If you demo 4 or 5 months, and then you go and pass your first funded, is that not worth it? Think about it. If you blow an account, it's a setback to your psychology, because now you start doubting yourself. Like, maybe I need to study more. Maybe you do, right? Maybe you do need to study more. Maybe that's something for you to analyze. But sometimes it's better to just practice, because, as they say, practice makes perfect, and then get into it. But it's better than blowing an account and just taking your time. As I always say, markets aren't running away. You have forever to trade, essentially, right? You can always come back to it later. You'd rather do it when you're ready properly than try to jump the gun. And if you do blow an account, don't be disheartened. It happens. It happened to me, and I'm funded now. So, it's a learning curve. Don't let it set you back too much, but also try to avoid it if you can, because you personally, you will know if you are ready or not. And if you're unsure if you're ready or not, just speak to me, and we can discuss a few things which might help you. But that is it for today's lesson. Right? No charts today, just a lot of talking. But I hope that helps. Hope that gives you guys a lot of insight, maybe changes some of your views on managing risk and managing trades. And as usual, any questions at all, guys, just hit me up.